Well, good morning, everyone, and welcome. My name is Bob Balopole, and this morning we're going to look at some historical data that's going to suggest that stocks are a superior long-term investment. And my sincere hope is that 20 years from now, you will look back on this day as the day when you learned an important lesson in life that improved your happiness. So I'd like to see a show of hands. How many of you believe, in general, that a stock investment is more risky than a bond investment? Let's see some hands. Hands, very good. Well, okay, just about everybody. That does not surprise me, because after all, we all know that stocks bounce around more on a daily basis or even a yearly basis than bonds or other fixed income investments. And we also know that with a bond, you're promised to get your principal back and your interest back. It's a legal obligation, whereas with a stock, you're along for the ride. So as good or bad as the company does, that's how you're going to do. And even the dividend that the stock may have been paying for 100 years, they could shut that off tomorrow and not even give you a reason. So I would agree with you that bonds are less risky in the short term, say on a 1 to 5 year basis. But the revelation that I think is going to come from looking at this long-term data this morning is that stocks are actually less risky than bonds over a longer time period, say 10 years or more. And the longer the time period, the less risky that bond is. The less risky the stock is. So I know a lot of you may be reluctant to hold stocks. You may have been traumatized by the losses of the 2008 financial crisis or the internet bubble that some of us remember from year 2000. But you need to focus on the long historical trend rather than these ups and downs that only last a year or two. After all, it's the long term that should be our concern. It is the prospect of outliving our savings that should be our number one problem. So when I see a person who is getting ready to retire shift their investments out of stocks and into fixed income in the belief that they're lowering their risk, I have to ask, what is your major concern? Is it having enough savings to get through the next 5 years? Or is it having enough savings to get through the next 20 or even 30 years? If it's the latter, then you need to look at the historical record. And looking at history will help you make an informed, rational choice about how to allocate your investments between those two major categories, namely fixed income, which could be a bond or a bond fund or a CD or a savings account, what have you, and equities, which include things like stocks, stock funds, and such. Okay, so these three charts I'm going to show you come from Professor Jeremy Siegel of the Wharton School, and it's from a book he wrote called Stocks for the Long Run. And this chart is entitled Real Returns, 1802 to 2002. So it's a 200-year study. It's the only study I've seen that has such a long time duration. And because of the length of time, I think it reveals some interesting patterns you might not catch otherwise. So along the bottom scale, we have the years 1802 going all the way up to the year 2002. This scale, we're starting here at $1, and for each line we go up, it increases by a factor of 10. So it's 10, 100, 1,000, 10,000. So this is what they call a logarithmic scale. If we didn't do that, the chart would be about 100 feet high. And we're going to explore the returns, the real returns, real meaning adjusted for inflation, for stocks, bonds, treasury bills, gold, and the US dollar. So if you had $1 US in 1802, 200 years later, it'll be worth 5 cents in terms of its purchasing power. If you had $1 of gold, 200 years later, it would be worth $4.52. Treasury bill would be worth $281. A bond would be worth $1,778. And stocks, $1 worth of stocks in 1802, if it had remained invested for the next 2 centuries, it would be worth $704,997. So I think most of you are aware a stock pays more than a bond, but I don't think you may know how dramatic the difference is over a very long time period. Now, of course, that time period might not be relevant to you because, after all, in the long run, we're all dead. So I prepared another little chart that I ran out for 30 years. So if you had $10,000 and invested it for 30 years in a bond at a typical bond interest rate of 3.6%, at the end of 30 years, that would be worth $29,000, whereas we're invested in stocks at the average rate of return of 6.6%, it'd be worth $68,000. So that's $68,000 versus $29,000. So that's almost 2.5 times as much. So perhaps you can relate to that. And before I forget, I want to mention this chart we have doesn't discuss real estate. It doesn't discuss insurance policies because we don't have any data on that. And so I think there might be a place for those in everybody's portfolio. But today, we're just going to focus on these 5 types of assets. The next point I want to make is that stocks are more volatile in the short run. And that's why you can see the line for stocks is much more of a sawtooth pattern than these lines for bonds, which are more smooth. But the last point I want to make, and the most important point I want to make, is the return on stocks is the most consistent over the long run. You see, the author has drawn a straight line through this chart for stocks, and you will see that the graph adheres fairly closely to this line, whereas you could not do the same thing with bonds. Early in our country's history, you see bonds had one rate of return, and then it flattened out for many years, and then it went up for another decade, and then it went down again, and then in the last, say, 20 years, it's gone up. But the point is that stocks are actually the most consistent return of all of these asset classes. Now, this next chart shows the amount of times that stocks outperform bonds for a given time period. So for just a 1-year period, stocks outperform bonds 58.8% of the time. And as you go to longer and longer time periods, if you're talking about a 30-year time period, and this is all of the 30-year time periods between 1802 and 2012, stocks will outperform bonds 91.2% of the time. And going back to 1871, stocks outperformed bonds 99.3% of the time. So that means in this 141-year time period, there's only been maybe 1 or 2 30-year periods where you would have done worse with stocks than with bonds. I've got one more chart. Okay. Can the audience see this all right? You getting a good shot of this? Okay. So you say to me, Bob, okay, that's fine, 90% of the time I'm better off in stocks, but what about the worst case scenario? This is what I'm really concerned about, is that once in a lifetime wipeout. I'd like to be protected against that. So that's what this chart addresses. This is the worst and best periods, 1802 to 2012. And here we got 1 year, 2 years, and so forth and so on. And we got 3 bars for each of these time periods. This first one is stocks, which is denoted here. The second one is bonds, and the third one is treasury bills. So, in any 1 year time period over this long history, the worst 1 year return for stocks was a loss of 38.6%. And the worst 1 year loss for bonds was 21.9%. So clearly, if you're just looking at 1 year, you would have done worse in stocks. But the interesting thing is, as you go to longer time periods, say 5 years, the worst 5-year period for stocks is almost the same as the worst 5-year period for bonds. And when you get up to 10 years, big surprise, it actually flips. So the worst 10-year period for bonds is actually worse than the worst 10-year period for stocks. And when you get to 20 years, look at this. The worst 20-year period for stocks is actually positive, and the gap between that and bonds widens. So what this bar here with its 1% return tells you is that there's never been a 20-year period in the history of the United States from 1802 to 2012 where anyone lost money in stocks on average. There's never been a 20-year period where on average the market failed to return at least 1%. So these historical facts challenge the usual way people allocate their investments, because most people operate on the false assumption that more fixed income always means less risk. Most people, how do they allocate their portfolio? Typically what I see is people just kind of reach out and grab a number. I want to be 60% stocks, 40% bonds. And then as they get older, they raise the percentage of fixed income or bonds. But we know now that there's no rational or data underpinning for that kind of decision, because if you're talking about a long time period, bonds are actually not safer than stocks. Unless you know you're going to die in 5 years, then that might be a scenario where you say, I want to be in bonds. But if you're uncertain how long you're going to live, you're more concerned about the long term, it's false to believe that bonds are safer than stocks over a period of 10 years or more. When I went through the Chartered Financial Analyst program, I was taught to calculate the client's required rate of return and then come up with an allocation of assets that just meets that required rate of return. So you end up holding enough stocks only to meet that required rate of return. But that method also makes no sense if your goal is to maximize returns and minimize your risk over a long period of time. So this was what I would propose you do. First, determine how much you're going to need to withdraw over the next 5 to 10 years from your investment portfolio, and only put enough investments into fixed income to satisfy that need. And everything else that you can put away for 10 years or more should be invested in stocks. And that way, the longer you live, the more likely it will be that your stocks will outperform your bonds. Now, 2 important caveats. This is all based on average returns. It's very easy to make bad stock investments and earn less than the average return. So I have to issue this one warning that you have to use a method that's proven by history to earn something close to average market returns. For instance, you could invest in index funds and track the market, or you could invest in a methodology that's been proven over time, like value investing. But if you're going to be, chasing after the hot stocks or doing day trading, this is not going to work out for you, I guarantee it. The second caveat, you have to make sure you can withstand those ups and downs, that you're not going to panic at the first time the stock market drops 10% and bail out, because that's not going to work for you either. So you have to commit to riding out the ups and downs of the stock market. Now, this brings up the question, do you want to tailor your investments to suit your emotions, or do you want to control your emotions and have the optimal investment portfolio? To give an example, let's say you have two people in the exact same financial situation, and one is a worrier and one is a not. So one is not, excuse me. So my question is, should one person have a different portfolio than the other just because one is more of a worrier than the other? So I don't think so. I don't particularly like to go to the dentist, but I do it because it's good for me. And I think people should hold the optimal investment mix for their situation. And if they don't like it, try to control that impulse rather than change your investments. I'm going to close with a few observations on stocks versus fixed income. When I was a CPA, I used to tell my clients the Dow Jones Industrial Average hit a peak in 1929 that it did not revisit until 1954, 25 years later. However, I now know, after studying Professor Siegel's charts, that in 1929, if you had remained fully invested in the stock market, it will have only taken 6 years to come back and make all your money back. And the reason it's 6 years, not 25 years, is the figure, the Dow Jones Industrial Average I was looking at, that does not include dividends, which are a very significant source of return, and that is not adjusted for inflation. So you have to remember, during the Great Depression, there was a big drop in prices, so people's, a dollar became worth more than a dollar. So remember that in the most severe cataclysm our country has ever had economically, it only took 6 years to recoup for people who hung in there. Now I want to talk about fixed income as well, which also has a few pitfalls. Seems like everybody realizes that inflation is bad for bondholders or other fixed income holders. But what most people don't realize is deflation, which is falling prices, can also be bad for bondholders, because when you have a lot of deflation, it makes it difficult, or if not impossible, for the debtors to pay back their debts, because the dollars they're paying back in become more valuable. So in order to have success as a bond investor, prices have to remain within a fairly stable band. And if there's either too much inflation or too much deflation, your investments may suffer. Another characteristic of fixed income investments is it creates a very inflexible relationship between the bondholder and the company that owes. I mean, there's no ability to work things out or reschedule things. The only thing the company can do is file for bankruptcy. So just like in a marriage, there has to be flexibility, and if there is none, the relationship will probably break. And similarly, that's a pitfall to fixed income investing. Also realize, when you buy a bond, you are now entering into a relationship with a company that is encumbered by debt. And I would rather, in many cases, be a stockholder in a company that has zero debt than be a bondholder in a company that has a significant amount of debt. You know, you might book the safest cabin on the Titanic, but if the ship is going to go down, you're going down with it. It doesn't matter that you're in the safest area. So just to recap, I showed you data showing that stocks far outperform bonds, while the riskiness of those stocks decreases as the time period increases. And therefore, I suggested you use fixed income to meet your short-term needs and put the remainder in stocks for the long run. Thank you for listening.